Can I actually grow my Canadian real estate portfolio by 20% this year using only smart tax strategies? As a real estate investor in Canada, you're likely no stranger to the complexities of our tax system. But what if you could uncover smart ways to save money and maximize your returns? That's exactly what we're going to dive into in this video, practical tips and strategies to help you crush Canadian real estate taxes and boost your profitability. One of the biggest challenges Canadian real estate investors face is navigating the tax implications of their investments. Take capital gains tax, for example. When you sell a property, you're required to report the gain on your tax return, which can be a significant hit to your bottom line. Then there's income tax on rental properties. Every month, you're collecting rent, but you're also on the hook for taxes on that income. And let's not forget property transfer taxes, which can add up quickly. These taxes can be a huge burden, and if you're not careful, you could end up losing thousands of dollars to the CRA. But here's the thing, with the right strategies, you can minimize your tax liability and keep more of your hard-earned money. It's all about understanding the tax implications of your investments and taking proactive steps to optimize your tax strategy. The problem is, many investors don't take the time to understand the tax implications of their investments. They might think, oh, I'll just deal with that later. But later can be too late, and before you know it, you're facing a massive tax bill that you never saw coming. That's why it's so important to stay on top of your taxes and make smart decisions about your investments. So, let's talk about some specific tax strategies that can help you save money. One of the most powerful tools in your toolkit is the principal residence exemption. If you're buying, selling, or owning a property, you need to understand how this exemption works. Essentially, it allows you to sell your primary residence tax-free, but there are rules and exceptions to be aware of. Another strategy is capital cost allowance, or depreciation. This allows you to claim a portion of the cost of your property as a tax deduction over time. It's a great way to reduce your taxable income, but you need to be careful not to overdo it. The CRA has rules around how much you can claim. You should also be thinking about holding properties in a corporation versus personally. There are pros and cons to each approach, but in general, holding properties in a corporation can provide more tax flexibility and protection. And don't forget to claim legitimate expenses. Every dollar you can write off is a dollar you won't have to pay taxes on. Claiming legitimate expenses can be a game changer for real estate investors. For example, if you're renting out a property, you can claim expenses like mortgage interest, property taxes, and maintenance costs. These expenses can add up quickly, and by claiming them, you can reduce your taxable income and save thousands of dollars on your tax bill. One of the most impactful tips I can share with you is to use a combination of these strategies to maximize your tax savings. For example, if you're holding properties in a corporation, you can use the capital cost allowance to reduce your corporate income, and then use the principal residence exemption to sell your personal residence tax-free. It's a powerful combination that can save you thousands of dollars. In summary, optimizing your tax strategy is crucial to maximizing your Canadian real estate investments. By understanding the tax implications of your investments and using smart tax strategies, you can save thousands of dollars and boost your profitability. If you've got your own tax-saving tips, share them with us in the comments below. We'd love to hear from you. Don't forget to subscribe to our channel for more real estate investment insights, and check out our other video on property management tips and tricks. Thanks for watching.